Good morning, everyone. Thank you for joining us for Investing in Historic Real Estate with our guest speaker, Gordon Short of GBX Group. Gordon is a managing director of GBX. He manages the firm's relationships with CPAs and financial advisory firms, supports government advocacy groups, and building relationships with local, state, and federal officials. Gordon has previously served as the chief investment officer for the state of Ohio in the treasurer's office. His work experience includes Ernst & Young, university hospitals, other prominent area CPA firms in the Cleveland, Ohio area. Gordon's currently not only councilman, but recently elected president of the City of Strongsville City Council, chairs their Economic Development Committee, and co-chairs their Finance Committee. Gordon's an attorney as well as a John Carroll accounting graduate, so he's got both the CPA and the Juris Doctor credentials. So I think the lawyer stuff is cool. Sorry you're afflicted with the CPA, although as you'll explain, you're kind of recovering in that area,
Yes.
Gordon, as you mentioned the other day.
Yeah.
So
Yes.
appreciate you joining us today and helping folks learn a little bit more about these easements and tax incentive opportunities. Not just from a folks who hold or have property, but from the investment standpoint as well. I think is a fantastic thing to learn about, and I was frankly surprised to know how many of our IC-DISC clients and firms that we work with in the area and outside the area as well have worked with you guys, and we've had a long time alliance with GBX as well as your sister firm Silver Road Consulting, and we've had Dennis on to speak. Some folks may recognize that the name from that, if nothing else. As far as questions, we'll do our best to try to answer what comes in on the chat function. You can also email anonymously your questions to info@quantitax.com. We'll try to answer what we can that comes in through there or the chat during the presentation, but we'll certainly be sure any questions outstanding will be answered afterwards. We'll go ahead and turn it over to Gordon, and Gordon will interject with questions that we get in. And thank you again for joining us, and have at it.
All right. Well, thank you, Amit, and thanks everybody for joining. It's another beautiful day here in Northeast Ohio. So I appreciate you taking the time. And like Amit said, I'm a recovering now tax accountant. I've been 9 years at GBX, and I did go back to law school after getting my CPA and accounting degree at John Carroll. And I realized the only thing worse than billing hours in a accounting firm were billing hours in a law firm. So I always stayed on the CPA side of things. And that has dovetailed me into GBX here and what we do in historic real estate. And much like Quantitax, which works with a section of the code that Congress provides an incentive that gives tax benefits and a tax incentive for people and businesses to operate and structure things in a certain way. They've done that with historic real estate. So we'll talk about that today in a couple of different programs that the Congress has implemented over the years, really since 1976. So we'll talk today about the Historic Preservation Easement Program, the Federal Historic Tax Credit Program, and we'll touch on some of the state stuff as well, although, again, more specifically here to Ohio. And we're going to look at the benefits, both from a social and economic impact from historic preservation and what these programs have done to help revitalize urban cores. And we'll talk a little bit about GBX Group and then answer your questions throughout the program, and we'll save some time at the end for questions as well. So we've got a robust agenda here to cover in about 50 minutes, so we'll dive right in. Some of you may or may not recognize this. This was torn down before I was born, but this is what Penn Station used to look like in New York City. It was a beautiful Greek architectural building built in 1910 by the Pennsylvania Railroad that stood for about 50, almost 60 years in New York City. And in the 60s, mid 60s, when the Pennsylvania Railroad ran out of money, it sold its air rights above in the building to become Madison Square Garden. and it was torn down to build MSG. And as we know, Penn Station still exists today, but it doesn't look like this, right? It's now just a labyrinth of tunnels and mazes down there to catch a subway or a train in New York City. And unfortunately, this beautiful piece of architecture could not be saved back then because there were really no programs to protect these types of structures, both from a tax perspective and even just a local, and legal perspective. And so unfortunately, this beautiful piece of architecture ended up in a trash heap and was destroyed and left, carted away and dumped in New Jersey. And so, but the destruction of Penn Station, I have to always say this famous quote, Vin Scully, the great announcer, said, "We used to enter New York City like gods, and now we scuttle in like rats." And so why I mention this is this was the catalyst for really the historic preservation movement in the United States, both from a legal perspective, but also Congress recognized, and as we approached our bicentennial in 1976, that there need to be some tax incentives and some policy to help incentivize owners of historic buildings to preserve them. So, much like, as we know, Congress does some things through the code to incentivize behavior. For example, they want everybody to try to own a home, so there's a home mortgage interest deduction. They created two programs in 1976 to help incentivize the preservation of historic architecture in the United States. You can go to Europe and you see buildings that are, 2,000 years old, 1,000 years old. Here in the States, we get to about 30 or 50 and we tear them down and we build new or we turn them into parking lots. So starting in 76, the bicentennial year, and hard to believe now we're going to be approaching 250 now in next year, birth, the birth of the United States, is the Federal Historic Preservation Easement Program. And we're going to talk about this in the Federal Historic Tax Credit Program, which are both in the Internal Revenue Code, but different sections and different ways they are structured. The easement program is under 170H of the code. It is, implemented by Congress. It's also a program that is both these programs tie together the Department of the Interior, the National Park Service, and the Treasury and IRS, because as we'll see here, the building has to be certified historic, which is done by the Secretary of the Interior. And then, the IRS and Treasury obviously implement the tax benefit side. But this is a program that is promoted by the National Park Service. We'll talk today primarily about this being used on commercial properties, but this can be used not only on commercial buildings, but also homes and smaller buildings, as long as they're deemed historic by the National Park Service. And so the first step in this is that the building must be on the National Register of Historic Places and certified being historic by the National Park Service. Now, the Preservation Easement Program generates a tax deduction. And obviously, the Federal Historic Tax Credit is a credit. So very different ways these programs benefit taxpayers and owners of historic structures when they implement these programs. And the key thing about the historic preservation easement is it protects that historic building in perpetuity. And we'll talk about that a little more here in a minute. To be considered historic, and again, this is all done through the National Park Service, at a minimum, we didn't set the bar too high here in the United States. The building has to be at least 50 years old or older, or has a significant historical event that would allow it to be considered historic by the National Park Service. And so, for example, the building may not be 50 years old, but it may be considered historically significant. So here in Cleveland, the old Ameritrust Tower was built by a famous architect who didn't do many buildings in the style that he did. So when that building was abandoned, when Society Bank at the time acquired Ameritrust and built a new tower in Cleveland, it sat empty. And so one of the things they did was they made it historic, because even though it was less than 50 years old, it was built in the late 60s. It was abandoned in the 90s. And in the early 2000s, it got the historic designation, was because of that architectural significance. So even though it wasn't 50 years old yet, it qualified. Now, an interesting, sidebar here is that when you travel around the country and you see that little plaque that says that the building is historic and on the National Registry and is a landmark in the United States, that does nothing to protect the building. People think they see that and that building is protected. No, that designation allows these programs and opens the door for these programs to be implemented on the building. But so if you don't have that designation, you can't implement these programs. But just by having a designation does not protect it under federal law. You could tear that building down the next day after it gets its designation. So that's why these programs were created and have to be implemented correctly to preserve and protect these buildings. So again, with the easement program, which again protects this building forever, which means the facade and anything else the National Park Service deems historic cannot ever be altered. Now, you can renovate the inside of it. You can rehab it. You can put a new roof on. Again, all subject to approvals by the National Park Service, or as we'll talk in a minute, the local charity that helps with this as well, the local not-for-profit that ensures that those historical characteristics are maintained in perpetuity. But at a minimum, to qualify for the program must be considered historic by the National Park Service and certified, or it is in a registered historic district and that building contributes to that district. So for example, here, GBX is based in Cleveland. We're right at 21st and Superior for those that are from Cleveland on the phone. And in the Superior Arts District, which was a designated district between basically 90 all the way to East 20th Street, some buildings in that are individually listed and some just contribute to the district, but that district is considered historic. That was the old garment district in Cleveland. And at one time in the 1920s, Cleveland was the biggest manufacturing of women's garments outside of New York City in the entire country. And so there's a lot of history there and a lot of historic buildings because of that fact. And the other thing that has to be key is that the public must have access to this, to the building, some visual or physical access to the public. So this can't be hidden up in the mountains somewhere to qualify to be historic. But once you have that, then you can begin to implement this program. The other part of it is you do need a qualified organization. So the easement is a legal restriction that spells out the restrictions based upon the historic characteristics of the building, what cannot be altered. And that is essentially donated to a local not-for-profit or qualified organization that can ensure in perpetuity that the historic characteristics of the building are met and maintained. So again, this is forever. So obviously the National Park Service doesn't have the resource and the ability to monitor every single building in every single city across the United States. So how Congress created this, one for efficiency and to ensure that the historic characteristics were preserved, but also to create the tax benefit, was that easement is filed at the local recorder's office. So when anybody goes to look at the building to buy it or acquire it and do a title search, you see these restrictions are on the building. And so it can never be torn down, right? It can never be altered without the approval of the qualified organization. But that is then donated by the owner of the building to that not-for-profit. So here in Cleveland, it's the local historic gateway district. And this isn't given to like the Salvation Army or Goodwill. It has to be a charity or government entity that can ensure and it has the wherewithal to maintain and ensure that the historic characteristics are preserved forever on that historic structure. And that springs to life the tax benefit, which creates a tax deduction on that building. And I'll talk about that in a second of how the tax benefit is calculated. So again, because this is forever and you're gonna get a tax benefit based upon basically the lost value of what you're giving up, essentially the future development rights in the building. You can never, the owner of the building cannot demolish or destroy the property. You generally cannot expand above or around that structure. You can't do any alterations without the permission of that qualified organization. You have to maintain from, it doesn't have to be from the day the building was built, but generally when you do a historic application to get on the register, you tie it back to what's called the period of significance. So the historic era of the building, like for example, our building in downtown Cleveland, we practice what we preach. It was built in 1913. We bought it in 2015, rehabbed it from the outside. It looked like it did from its period of significance, which was in the 1920s. The windows look the same, even though they're new windows. The exterior has been renovated, and there was a lot of work to be done on the exterior brick, which had been worn away after 110 years and a lot of years of neglect. Although interesting little sidebar, the National Park Service and the local historic Gateway District, when we had to replace, bricks around the top of the building, obviously new bricks haven't had 110 years of weather. We actually had to hire a company that specialized in basically a chemical like abrasion of those bricks to weather them so they match more of the exterior of the building. So there's a lot that goes into this historic characteristics. Now you can, again, alter the interior of the building, rehab it. If you walk into our building, and then if you're in Cleveland, I invite you to come down for a tour. But it's a 21st century office building. I mean, it's inside has, cubicles, glass offices, Wi-Fi, everything from the inside looks, is a 21st century office building. But if you look at it from the outside, it looks like it did from a picture that we have on the wall from 1920. Now, a couple interesting facts here, though, too. Talk about, looking at and asking the National Park Service and the local not-for-profit for alterations. One, there's different building codes, fire codes, et cetera, nowadays, and there were, 100 years ago, 110 years ago in these buildings. So, for example, something that we went round and round with the National Park Service and the donee organization was the addition of a wheelchair ramp, obviously to comply with, because we were doing renovations, the American with Disabilities Act. That wasn't around 110 years ago. And so we had to have handicap access into the structure. So we finally agreed that, again, these buildings have to look from the public viewpoint, from the exterior, like they did from the historic period of significance. So we agreed then, and the National Park Service agreed to put the wheelchair ramp at the back of our building, so you couldn't see it from anywhere from the street level at all, any angle from the street. So our main entrance is actually the back of the building, not the front, because of that addition and the ability to get handicapped people into our building. But that had to be approved and done before we could do anything. And then an interior modification we made was adding. This was an old factory that made garments. So every floor was solid wood. Well, we wanted to cut a hole through 3 floors to make a, staircase, stairwell, an interior stairwell for our employees to go up and down in. That was met with resistance until it was determined we could put it in an area of the building where you could not see it from the outside. I mean, if anybody looked in the window, they could not see that stairwell cut in the building. So it starts on the 3rd floor, not the 1st. For that reason. And so those are little things that can happen, because if you do not follow, and if you by some reason happen to overstep your bounds and remove something that's historic, you could lose these benefits, especially during the rehab process, or in a future date if you do something that the donee organization does not approve of. So if you do all that, you're historic, you're designated historic, you've done all your work to ensure that you keep that designation. How's the tax incentive calculated? Again, this is a tax deduction, and basically it's based upon the fair market value of the highest and best use of what could that building be. So and basically you have to look at 4 really factors in looking at an appraisal, because again, this will be a hypothetical of a building that could be built. So if you could tear that building down or build around it, is it legally permissible? Do you have the right zoning? So in Cleveland, we have free and clear zoning rights in Cleveland. They're not restricted by any local laws. This program, while you would think this would great in New York City, which has some very old and beautiful historic structures, it doesn't, because New York has local laws that restrict any building around the airspace of a historic building. So if you can't build around it anyways because of local restriction, you're giving up no value. There's no lost value there, so there's no tax benefit there. It has to be financially feasible. Could you build it? Is there a market to say, if you tore down that building in downtown Cleveland and you needed, you could build a residential tower there? Is there a market for that? What's the cost per square foot? Can you physically build it? Can you actually? And we will hire architects and engineers to design a building to be structured, to be built, so that we have to demonstrate that it is physically possible to be built. And what's the maximum use for it? Again, what's the market for that? Is there a market for, whether it be office space, commercial, mixed use, or residential? Is there a market for that? And and on the physically possible stuff, a great example is a building we did in Columbia, South Carolina a few years back, where by right, we could build up to 30 stories, but when the engineers did a sample of the soil down there, the sandy soil can only support 20 stories. So you had to cut back your hypotheticals because, again, you can only build what's physically possible at that time. So I like this visual example I'm going to show you.
Back on that last slide, Gordon, if you don't mind for a second.
Sure.
Could you tell us both benefiting directly, and I guess if there's a way to benefit indirectly other than the owner of the building where the easements apply, what is your typical profile of companies that are companies or individuals that are able to benefit here on the easement program? So
for the because this generates a tax deduction, actually it's a non-charitable tax deduction that flows up, subject to the 50% adjusted gross income limitation. This tends to work for obviously owners of buildings. If it's an LLC or S corp that flows through, that can take that tax benefit at the individual level. We'll talk a little bit later in the presentation about individuals that can do this through a fund structure that we have. Again, if they have adjusted gross income in the top marginal tax bracket, because again, it generates a tax deduction for them, and because it's a tax deduction, it's based upon your tax rate. For this program, it doesn't work well for C corps because with a 21% tax rate, the tax deduction, every dollar deducted is only at 21 cents versus a 37% rate for individuals. But those that have S corps, through S corp LLCs or individuals, this tends to work better for the tax benefit of it. Outside, if you own the building and looking for a way to monetize some of these tax benefits, but generally those are the people that benefit or entities that benefit the most from the historic preservation easement program.
Got it. And are there any easement programs for being historically bad? Like maybe we'd have the Browns Stadium, designated as
I think most people want that torn down, but actually it brings up a good point though. Again, there's a building, a stadium that's 30 years old, not even 30 years old, and it's already pretty much at the end of its useful life, and they want to tear it down. Now, I think most people want that stadium either rebuilt elsewhere or torn down and rebuilt on the lakefront. But when it comes to historic structures, we want to try to get a lot more use out of them. So
there's no useful life to that thing.
No, right, exactly.
As a Browns fan, there's been no useful life there.
Yeah, correct.
Sorry.
That's right. So what I'm showing here, everyone, is this is an actual building that we did in Louisville, Kentucky, a historic structure, only 3 stories, using the historic preservation easement program. And how the tax benefit from this was calculated, and I'm going to go back a slide here, is again highest and best use. What could be built there? So in this hypothetical, if a structure, for market rate condos or apartments could be built around that structure, by preserving it in perpetuity, you as the owner of the building are giving up that future value, because once that's preserved, right, it's going to look like this forever. Now, again, this is after rehabilitation. There's a restaurant on the bottom. These 2 floors are actually leased out to Angels Envy's management in corporate headquarters. They lease those 2 floors, so it's become a fully functioning office building. But the key here is without that incentive, because it costs so much to rehab. Generally, it costs anywhere 30 to 50% more to rehab historic buildings than it is to tear down and build new, or just let them sit empty or turn them into parking lots. That's why this incentive is there, to add this additional piece to the capital stack. So, the money raised through historic preservation easements that are used to purchase and rehab the buildings, and in exchange for that investment, investors, receive the tax benefit, which we'll talk a little bit more in detail. But a lot of that value is generated from the loss of these future development rights around the air rights of the building. But because we did that, this once vacant building is now a fully functioning, restaurant and office building in downtown Louisville, Kentucky. And we have examples all across Cleveland as well here. I mean, Superior Avenue District, the Art Craft building is becoming the new police station here. Cross Country Mortgage moved their buildings down to buildings we preserved on Superior Avenue. In the flats, the Sam's Hill buildings we bought and are being rehabbed. And then the old Odeon Theater we bought, we are in the process of rehabilitating that to become a music venue once again. So we hope within 12 to 24 months, the East Bank of the Flats will kind of be rejuvenated. Not what it was back in the old 1990s, but certainly an entertainment district for people to not only go to visit, but also live down there as well. So for the tax incentive, again, it is a non-charitable tax deduction for us accountants on there, getting to the weeds a little bit, subject to a 50% adjusted gross income limitation. Used to prior to the 17 Tax Act, doesn't AMT used to affect this more, but generally with the AMT now being reduced after the 17 Act, that generally doesn't affect who can deduct these on an individual level. And also you need an 8283 with this because that deduction will be more than $500 on that. So this program has been around since 1976. It's been tweaked a lot by Congress over the years in response to market conditions and also some abuse in the programs over the years. And so, one thing I want to talk about as well is, how's the IRS look at these programs and enforcement of the program. So on the easement side, one of the big tax incentives is that this tax deduction is a non-cash charitable, but it's for every dollar generally you invest, because that fair market value is the deduction amount. It's generally can be greater sometimes than what the initial investment is. So if, under IRS rules now, for every dollar that's invested, you can take no more than a $2.50 deduction on an easement deduction, both either historic preservation easements or something else called a land easement, which we won't talk about today. But there was a lot of abuse, in the last 10 years on the land easement side, which was a similar concept where you would preserve a piece of land and they end up syndicating those tax benefits out, but at a much higher deduction ratio of 5 or sometimes 10 times deduction with no economic benefit to it. With historic preservation easements, it's less of a tax benefit, but you also share in the underlying real estate. So there was true economic substance there in historic preservation easements. So in response to the abuse on the land side, the IRS capped through a notice any type of easement at 2.5 times its deduction, really trying to stop inflated appraisals. And then in response to that and what was going on, especially in the land easement space, Congress at the end of 2022 in the Omnibus Act, which had Secure 2.0 in it, they codified that 2.5-1 limitation and actually said any easement done has to be held for 3 years before you can take the deduction, except for historic structures. Congress realized that really there was true economic benefit and true value in easements on historic structures. So while they severely limited what could happen on the land side, they exempted historic structures other than requiring the 8283 reporting requirement to be part of any filing in a year an easement has been taken, historic easement has been taken. And they just issued final regs on this a couple months ago. And basically, the 8283 has to be completed. If not, the deduction could be disallowed to the investor and or the owner of the building if an 8283 isn't properly reported in the year of the tax deduction. So it's very key that is filed for any clients and or investors who invest in historic easements. So that's historic easements. Let's move into historic tax credits. Again, a very similar program, a very different. This generates a tax credit, which is a dollar for reduction, obviously, of any tax generated or any tax liability by an individual or a corporation. So this too is in the tax code. Again, started in 1976, has been tweaked over the years. This is Section 47 of the IRC, with the historic tax credit, unlike the preservation easement, which protects a building in perpetuity and generates a tax deduction for the lost value of those future development rights, the historic tax credit is a 20% credit of qualifying expenses associated with the rehabilitation of a building. So one, very different, from the easement program, that it's a credit, not a deduction. And two, This is based upon the rehabilitation cost. So to qualify for this one, you must be historic, as we discussed, and still meet those same requirements of being certified by the National Park Service as a historic structure to the United States, or contributing to a district as well. But then with the historic tax credit program, from a federal perspective, your rehabilitation costs must be excess or exceed your basis in the building. So if an owner of a historic building bought that building for $100,000 and only has $99,900 of rehab costs, the HTC does not qualify. If that owner paid $100,000 and put $100,001 into it, they then qualify. It's 20% of those rehab costs are associated with that. So, if you had $100,000 in rehabilitation costs, that's a $20,000 credit. In the past, this used to be you used to be able to take the credit in the year the building was placed in service. However, now the credit is still springs to life essentially when the building is placed in service, but under the 17 Tax Act, as part of the compromise there, and some of the revenue sharing and cost mitigation, the HTCs are now spread out over a 5-year period. So if you have a $20,000 credit, you have to take $4,000 a year for 5 years. Now, again, preservation easement is a tax deduction that pretty much individuals and entities that are in a higher tax bracket or flow throughs like LLCs and S corps can take more advantage of. The historic tax credit is considered a passive activity credit. So as we know, because we're all smart tax accountants on this call, that you can only offset passive losses or passive credits against passive income. So generally, the federal HTC is not great at the individual level unless they have passive income or active real estate professionals. But where we see a lot of federal historic tax credit utilization is by C corporations, insurance companies, and banks, because these can also be syndicated out as well. And much like with the preservation easement, where owners of buildings and developers will implement the program and then monetize those incentives. The same with the federal historic tax credit. Generally, those credits are worth $1 in federal tax reduction. Depending on the project, the economics of it, where it's located, you could see an investor or a C corp pay maybe 75 to 90 cents on the dollar for a dollar credit, and then the developer or owner will use that capital in their capital stack to rehab the building. Because again, without these incentives in the capital stack, it's really hard to make these historic rehabs pencil out, especially if you're looking for loans from banks and other sources of financing. An additional $1 million, $2 million for one of these programs or taken together can really help solidify a capital stack for a developer. And in that regard too, you can layer these programs, and they're not mutually exclusive. So generally, it's best to, if you're looking at a historic building and you want to utilize both programs, is to first utilize the easement program first to require to get the capital to acquire the building, and then once that building has been acquired and rehabilitation costs have been calculated, then to go ahead with then doing the federal historic tax credit program on the building. And then actually another great point and a big difference in the programs is, again, the preservation easement program looks at and protects that building in perpetuity. If you don't do the preservation easement program on a building and you only do the federal HTC program, it only protects it for 5 years. And so that's a huge difference, and why also too you see a great difference in the value of the tax incentives to the owners of historic buildings. But on a federal HTC, after 5 years, that expires from the day it's placed in service, then you could tear that building down if you wanted to, or alter it in any way. There's no requirement, like under the easement program, that it be protected forever. So that's a very big difference too in terms of the protection of the historic characteristics of the building, which is why here at GBX, we try to utilize both programs, the easement program first to protect it forever, and then the HTCs for that additional capital to rehab the buildings. So the Federal Historic Tax Credit Program is pretty straightforward. Again, 20% over 5 years of rehabilitation costs in excess of the basis of the building that can be syndicated out to investors. And again, C Corps, usually banks, insurance companies buy a lot of those as long as they have a tax liability to absorb that tax credit. On the state side, there's a lot of states that offer different types of historic tax credits. Here in Ohio, and every state's different. Some model the federal model of rehab costs, et cetera. In Ohio, ours is different. One, it's set up where the legislature, every 2 years allocates how much per year can be allocated to historic tax credits. Once that is determined by the legislature, then the office under the governor, director of development, then twice a year has an application process where owners will fill out an application, it's scored, and then based upon that score, the amount of credits are allocated to those projects. And they can be anywhere from a couple $100,000 to up to $5 million in the state of Ohio for that. And then those are Ohio credits that offset only Ohio liability. Generally, again, the owners and developers will syndicate those out to Ohio taxpayers that have Ohio tax liability. Again, same thing, anywhere from, generally right now we're seeing about 85 to 87 cents on the dollar for $1 Ohio tax credit. And again, that's another part of the capital stack for the investors and the developers. And then obviously a tax benefit in the year that they're required for those Ohio investors. And again, about 35 states offer this. Some version of the Ohio program, some are more like the federal, and everything in between. I would always say that if you have a client that is in a state that has these, it might be something to have them invest in just from a personal liability perspective. If you have developer clients that are looking at, either own or looking at acquiring historic buildings, to know about both the federal and the state programs that are available to help build that capital stack for the purchase and or the rehab of those historic buildings. So again, let's look at why and some of the actual social and economic impact that historic preservation has had. And again, one of the reasons why Congress implemented this program back in 1976. And it's actually one of the historic rehabilitation programs have proven here, and not just GBX or Gordon saying this, through National Park Service reports, Rutgers University, and other areas that have done research and analysis on what this has meant to cities and urban areas. Because again, when you're rehabbing these buildings, use these programs, you're bringing them back to life. So people are these are helping to revitalize downtown urban areas. People are going to live in these buildings, they're going to work in these buildings, they're going to pay taxes in those buildings in the form of payroll taxes, higher real estate taxes once these buildings are rehabilitated and put back in service. So since 76, this is just the historic tax credit impact. There were 3.2 million jobs created, both in terms of construction and also in terms of businesses going into these historic buildings. Over 48,000 projects have been certified, again, just on the tax credit side, and almost 235 billion in rehabilitation investment. And again, this is actually from a 2022 National Park Service report. So some stuff I want to show you here that we've done at GBX.
I'm sorry, Gordon. Could you go back to that slide for 1 second?
Sure.
I'm sorry. So I see the sources here and the the impacts and so on and so forth, some of the numbers here. Could you, just from a practitioner in this area standpoint, and again, this is just the credits here on this slide, not the easement stuff that we talked about earlier, right?
Correct.
So I'm just right. So I wanted to ask you if you have a rough idea or feeling as a practitioner in this area, like the folks that are taking advantage of the tax credits, if you had a rough breakdown of Obviously you mentioned it can be C corps, it can be individuals with passive or the real estate. Like, who would you estimate is taking advantage of this the most? I guess again, the profile of the people taking advantage of these credits typically,
Yeah.
or yeah.
Yeah, so from the investment standpoint, really it is large C corps and banks are probably the two biggest ones. Because the
Okay.
passive rules don't apply to them. So, and especially depending on the pricing of the credits too, but that's generally where we see because C corps with large amounts of tax liability, again, even though they're only paying a 21% rate, 21% of 100 million is still a lot of money, right? so
Yeah,
so
right,
that's where we
right.
see a lot of these being syndicated off to are C corps with large tax liabilities, and banks tend to be the top two. Then insurance companies, and then after that, you'll have smaller amounts with real estate professionals and individuals that have the passive income.
Individuals with passive income. Okay, great. Thank you.
You're welcome. So real quick, as we're getting close on time here, I want to save a few minutes at the end for questions. But these are actual buildings that GBX acquired through a fund. And what we do at GBX, just from a high level, is we will acquire historic buildings in a fund model for using the preservation easement purposes, where we will acquire them and then pass the tax benefits on to our investors. And I'll show that in a minute about how that's worked. But this was Columbia, South Carolina, Main Street. About 10 years ago, it was in really bad shape, really run down. You can see a lot of buildings in disrepair, historic structures that were just kind of sitting there unused. And again, without the historic preservation easement program, these buildings didn't pencil. By the way, if you see the little tower back here, that's a good kind of a fact too for the highest and best use. Are there other structures of that size around these historic buildings to demonstrate that there is a need for and value for those air rights above these historic structures? So these buildings were built in the teens and early 20s. They were vacant. Again, going back to those original facts of what you need to make this work. Again, not well in New York City because you have limited zoning there. Here in Columbia, South Carolina, it was unlimited zoning. There was a local not-for-profit to manage the easements and to ensure that these buildings maintain their characteristics forever in perpetuity. And so, we go through, looking through these questions to see, does it make sense? Is it historic? These buildings end up being certified and on the National Register. And so at the end of the day, we looked at, can we get all this done? Does it make sense to buy and implement the program? Then can you also get additional federal and state historic tax credits on the building, which we did for this program. So after all that was said and done, this is now a beautiful boutique hotel called the Hotel Trendle down in Columbia, South Carolina. And again, without the easement program and then additionally the federal and state historic tax credits, this project would never pencil. But now it's an operating business. That, in fact, it helped become a catalyst to revitalize the entire Main Street of Columbia, South Carolina, right near the University of South Carolina. And again, but it's a building, it's a hotel now, generates revenue, property taxes, payroll taxes, et cetera. So again, an example that these programs actually return money to the Treasury. It's been demonstrated that over about 5 years, the Treasury recoups the tax credit and or easement money that was done on a building within about 5 years back to the U.S. Treasury. I don't know if any of us have been up to Detroit, but this is a great story. The Weston Book Cadillac. This was a tax credit project. And this is what it looked like. It was a terrible, rundown, disrepaired building that utilizing historic tax credits was really a big piece of the capital stack to get the financing to rehab this into the Weston Book Cadillac. But this room now looks like this today. And again, without this program, that building probably would have been torn down or continued to be in disrepair. And now it's been a functioning hotel probably for almost 12 to 13 years now. That was one of our earlier projects back in, I think, 2010 that was done. So that leads into about GBX Group here. So we are based in Cleveland, Ohio. So, we really take this kind of like soup to nuts. We identify these buildings, we acquire them, we will partner with developers to rehab them. And then once they're functioning, we will manage them as well for our investors. We generally hold buildings for a 5 to 12-year period. In our funds, our investors have a minimum, they have to stay in the fund for at least the first 5 years, but they also share in the underlying benefits. So From a numbers perspective, I know we're all CPAs here. We like to see the numbers and walk through the numbers. So on a $100,000 investment in our funds generates a $2.45 non-cash charitable tax deduction. Again, this is from the easement perspective. This is the initial fund to acquire buildings. Every year we do a new fund because everything has to be, acquired and closed on in that year to have the tax benefits accrue to that tax year. So a $100,000 investment would generate a $245,000 non-cash charitable tax deduction. If you're in the top tax bracket of 37%, which just shows here, that returns to you in year one in the form of an actual reduction of your individual tax liability, $90,650 to our investors. And then again, they're sharing in a fund with underlying real estate, so they'll share in the cash flows from those, about $10,000 on the dollar to be made whole. And then if they choose to exit after 5 years, our target is to get $1.50 to every dollar they invest. And that $1.50 is in the form of tax benefits and cash. So another about 49 cents or 49,000 or $100,000 investment on the back end. So that, a dollar they could have paid Uncle Sam returns $1.50 in the form of tax benefit and cash over five years. Now, I'm showing this based upon like an Ohio investor. There's no state benefit to an Ohio investor. But if you have clients, individuals that live in states like California, New York, and there's about 28 others that recognize the non-cash charitable, there could be significant state benefits as well that we don't factor into our returns. But we have seen this to be a great tax planning tool for high income individuals as a way to mitigate that tax liability. Again, a $2.45 deduction is a lot more, powerful than, if you have a regular dollar to charity, you get a dollar deduction, generates 37 cents on the dollar. Here, a dollar deduction at $2.45 will return almost 91 cents on the dollar in year one. So it's a very significant tax planning tool that allows for what Congress intended, us to go out and preserve and acquire historic properties for rehabilitation.
So this fund, Gordon, then what the example is shown here, obviously the math doesn't work out for a C Corp, public or private C Corp, right? Anyone that's got that 21%.
Yeah, at 21%,
rate, yeah.
Or for somebody that's just making capital gain income.
Sure.
But we found people have a good mix of OI and cap gain, depending on how high their ordinary income is. This makes sense for. But yeah, if you're a C Corp at 21, or an individual just at all 20%, they're 23 with the Obamacare taxes, it doesn't make sense unless you have a really big state benefit.
Right, but those individuals certainly with the passive income and that top bracket are is a nice payback in year one. I mean, you're almost caught up there.
Correct. Yeah, exactly. And then as well, for us CPAs on the phone, you're probably thinking, well, hey, Gordon, geez, how can I get $100,000 investment but get a $245,000 tax benefit? Isn't that subject to at-risk rules or passive activity rules? Or how can I get a tax benefit greater than my investment amount? And it's a great question I know you're all thinking of. And the answer is because that $100,000 and that $245 is the fair market value of the lost development rights given up. And so just under general partnership law, this was actually a revenue ruling in 96 and then codified in the 17 Tax Act. Basically, you're giving up, it's the partnership giving out a non-cash asset, which is the easement and part of the building facade. And so any partnership that gives away a non-cash asset, it's the deduction is based upon the fair market value of the asset given away. But the basis reduction is the partner's inside basis of the asset given away. And the easement really has no basis. And the facade is generally at 10 to 20% of the basis of the building. So the calculation is done every year. So generally, the fair market value of the deduction is passed up to the investors, which is the $245. So in this example here, it'd be a $245,000 non-cash shareable deduction. But their basis on a $100,000 investment may only be reduced by maybe, let's say, $20,000 at the most. So they would still have $80,000 of basis after that. And because this is a non-cash charitable deduction, it's not an item of income, so it's not subject to at-risk rules or any of the passive activity limitation rules. Now, Obviously, this is a real estate fund, and any underlying taxable losses flowing up are passive losses or passive income if there's income, but the charitable deduction is not subject to those types of rules. So just some examples of the properties we did in 2023. Again, we do these all across the country. This is in Asheville, North Carolina. Again, you can see a taller building in the background, smaller historic structure, again, that had good air right value. Luckily for us, Hurricane Helene didn't do much damage to this building in our 23 fund, but it's in the process of being renovated and upgraded. It's retail and it's apartment spaces above. Now, not every building has to be a small commercial building. This here is a church in Nashville, Tennessee, that'll be converted into like a bed and breakfast. But again, a great historic structure. Again, the cost of it and turning into a B&B would be too much without the easement and historic capital being brought to this project in Nashville, Tennessee. And again, we all know Nashville is doing very well, so a B&B there is projected to do well. This is another one in Nashville as well, a historic building that was built in 1898. Again, you can see in the background here the Sheridan, the high-rise building there. This building is actually being renovated while it's still occupied by some tenants. The plan is to keep, first floor retail, and it'll be an office building in downtown Nashville, Tennessee, that's already almost fully leased out and operating while we're rehabbing it. So you can see there's some pretty interesting structures across the country that we can renovate and utilize this program. So again, just to summarize, I'll save 5 minutes here for questions. And this was put in place to save and preserve American architecture and revitalize communities. It's been doing that in downtown urban cores across the country, but it does provide a valuable tax incentive to owners and to investors to entice them to save these historic buildings. But the key is got to be executed correctly, ensuring both you are checking the box on ensuring the National Park Service that it is historic, and also to ensuring that the tax benefits are structured correctly to ensure that deduction is properly recognized by the IRS and the Treasury Department. So with that, I know we only got about 3 or 4 minutes left. Do we have any questions for me?
I have a question that came in through the email, which was just asking about basically in enforcement and how often on the historic tax credit side, structures that are invested into will have issues complying with basically with the requirements.
Yeah, sure. I mean, it is an area that the IRS does monitor frequently, especially given the abuse on the land side. So I'm a recovering tax accountant. Our founder is as well. We have a lot of CPAs on staff. So even from the beginning, we realized that when you're taking a tax deduction, especially one that's in excess of what you're donating, that the IRS is going to scrutinize it. So they do audit. They don't really audit the funds or investors. They audit the underlying buildings where the easement is placed. And so that's where those audits happen. Since 22 and the change in the Tax Act, where Congress kind of recertified or gave its stamp of approval to historic easements, that tone has kind of changed a bit, especially since a lot of the abuse of land easements were ended by the legislation. But without getting too deep into the weeds, at GBX, to kind of mitigate that risk to our investors, we do keep a valuation reserve and a cash reserve on hand, because we make the tax election under the BBA of 15 that that any liability or anything in excess of our reserves that would cause a payment due to the IRS would be paid for by the partnership and not passed out to investors. That has never happened, by the way, but we do make that election to protect our investors from IRS audits. But we do fully expect them to audit those appraisals, because again, those appraisals and deductions are based upon a hypothetical structure that's not going to be built, but is almost ready to be built. So if you think about it, you could have, two real estate appraisals look at a real building and have very different answers, different numbers, more art than science. So the same can be said for hypothetical. So we've always been very conservative in that valuation as well, in case of IRS scrutiny.
And then we have just one other one asking about on the historical tax credits eligibility for privately held C corporations with tax liability as opposed to public.
Nope, private.
Don't think it matters, right?
Doesn't matter. No, any C corp, whether public or private, if they have the tax liability, can utilize the historic tax credits.
Okay, so yeah, similar to the renewable energy credits that we'll be having a speaker on Friday and Monday for webinars for anyone else is interested. I know that you guys do some on the larger end as well, obviously with Rafe and his group at GBX. Is also told us, I know that private or public any C corp tax liability would be okay. I think initially there was some concern that with some folks I know we had that were looking into that the at-risk rules would apply, but there's a exception for was it closely held C corp, CHCs, I guess they term them. So some similar thing here. So, all right, great. Well, thank you very much, Gordon. That was very informative.
Yeah, and just one thing I want to say, I mean, is in terms of tax credit side too at GBX, we do source those as well, both the federal and state. And also too, I'll throw out there for anybody on the call too, Ohio has an Ohio Opportunity Zone credit as well. That, again, for individuals in Ohio that have an Ohio tax liability, there are OZ credits as well. We didn't talk about those today, but those are available as well to help with Ohio tax liability as well. And my contact information is up there. Feel free to email or call me with any questions on the easement or any type of the tax credits that may be out there to help mitigate a client's tax liability.
Great. Well, thanks very much, Gordon. And thanks everyone for your time. And Gordon, thank you so much.
Thanks everyone. Have a great day. Stay warm. Thanks. See you.
Thank you much. Bye.